All right. Good morning, everybody. TGIF. So the markets took a little turn. I did point out that there was going to be some data out of Japan, and hopefully you took note of that. Market's still going to rebalance a little bit. We're going to get inflation expectations today, and that goes back to that warm, fuzzy feeling. The market loses its mojo and might might get a little violent. Looking at what's going on right now, the Nasdaq is down the least. UK right behind that. We're still getting data out of Europe and the UK. Then the S&P at about a 0.5%. The Dow behind that, beyond a 0.5%. Japan nearly down 1%. Hong Kong more than a half, and the Russell down more than 1.25. So if we do start to flip today, I would rather go long in something that's down the most. Not typically a huge fan of trading the Russell, but might be worth taking a look in that direction. Sure. Like I always say, focus on doing the easy stuff. I don't hold a grudge when it comes to which of the products I'll trade, whichever one's got the better chart. So we're also going to get more Fed speakers. We're getting a couple today. I'm uh, positive we're going to see a lot more next week. They're all going to come out and try to sound like they are independent thinkers without someone's hand on their backside. But at the end of the day, we know they're just puppets getting their strings pulled, and they're all chipping teeth out of the same hymn book. Just remember, they do have a goal. They want to present a unified front and get the message across always, whatever that message happens to be. And right now it's higher for longer. Although higher for longer really doesn't fit. I keep hearing people say higher for longer, and it implies we're going to continue to raise rates. And maybe that's just my interpretation of it, but staying high for longer is different than higher for longer. So maybe it's just a nuanced difference, but they're not going to raise anymore. They're just not going to cut. So we get European Central Bank, Christine Lagarde. We got Cook, Goolsby. It's a lot today that were just across the board. Some of these we've already got. Just got to adjust this. That's better. So you can see high impact anticipation. There's also hedging. I'll point that out when we get to the charts. And I like how Finance Juice just has them all grouped together there, nice and easy for you to see. I don't know what their metric is for pointing out who's got earnings or not. We've had some big names do earnings in the last week, and I haven't seen any of them on here. But when it's something really big like Apple, Microsoft, Nvidia, those were here on the right. So I don't know. I'd like to see them do a little bit more when it comes to earnings, but they already do enough. Yeah. 5411 cog line. Just keep that one in mind for today. Spot Gamma has not yet come out with their AM founders notes. So when they do, I will, of course, share that, get a little insight from them on the levels for today, particularly that call wall. I'm about to update the levels. We'll see if they moved that call wall or not. I believe they did. We don't have to guess or assume. Yeah, there it is. 55.71. Now, rolling up that call wall is a bullish sentiment. If they were bearish, they wouldn't have rolled it up. Then they very likely wouldn't have rolled it down either, but they wouldn't have rolled it up. So I'm going to look at that as a bullish implication. The volatility trigger is above us. That's got some weight to it, although I'm sure that Spot Gamma's note is going to do a much better job than I could do of talking about this volatility trigger. And the put wall, 52.77. So we got a bit of a distance on each side. We're not being squeezed on either one. You know, like you know, when you're standing at the store waiting in line and someone just gets in your space, crowding you a little bit. That's kind of like these put wall and call walls. We don't want them too close to price. Um, at least the call side, we don't want too close to price as like a resistance holding us back. The put wall, on the other hand, if they would roll that put wall up near price after they've already rolled the call wall up away from price, that would be even more bullish. If I had seen that, then I'd approach the next week with a completely different point of view. You can see we got a lot of volume in the overnight, 178. I don't remember the last time we had numbers in the 150s. I think it was a couple weeks ago, but that's a solid amount of volume. And the volume's been really light. I mean, really light over the last week or so. So it's good to see this volume. And I guess I should say the volume's been light through the entire day, not just in the mornings. The mornings have been great. 85s, 70s, 90s. Those are really good numbers. It's more of it's been light if you look at the totality of the trading day. It's been a little light. But this is a really big print, and there's a little oddity here. Generally, when they are hedging, they're sitting out. They're doing one or the other. We don't generally get both. And today we have both. We've got a lot of volume and they are hedging. Now, the week still needs to end, but we can examine the week that we've got so far and consider the fact that we are inside week breakout. We were inside the previous week, and then we broke out of it, inside week breakout. So far, we're holding it, and we want to keep this breakout. Now, it's above the round number 5,400. I kind of want to stay above that round number too, but it's more important that we just stay outside of the previous week. Now that we've broke out of it, we need to keep it. If we do get back down inside the previous week, then we need to stay higher than the close of last week. Just benchmark levels, right? Stay above the round number, stay above last week, stay above last week's close. If we continue to go to the downside, those will be targets we'll aim for. Last week's high, last week's close. What we can also do is examine last week's range, put our measurements to the upside, and look how far the ES went up this week, right to the measured move. So when we consider blue skies, and I've heard this from people, oh, I don't have any levels. We've never been here before. How do I know how far it's going? Measure it. Right? Basic candle analysis 101. We can measure a candle. and project its range up or down, measured move 50% and 100%. And of course, when I tell people this, they usually say, but I don't know anything about Fibonacci's. Well, that's good because this isn't Fibonacci's. These are quadrant levels. So with quadrant levels, it's exactly like it sounds. It's just a quadrant. There's no mathematics to it per se. We're measuring 100% of this candle, and we're going to project that 50% and then 100%. You can do that to the upside and to the downside so that no matter which direction we break out of, you've got your measured moves. Now, price doesn't necessarily owe us a pause at a 50% or at 100% of the move. But just like we had this week, it's often the line in the sand that we need to get through. If we'd have made it above this 50% mark, we could have perhaps tried to use that as some sort of minor technical support level. We didn't make it through there because it was technically still a resistance level, and it did resist us. This is, of course, a short measurement. If we wanted something with more structure to it, we could measure the entire pullback that we had taken here before the breakout, and we can plot that to the upside. Funny enough, it gives us the same level. It's also around number 5450. Another thing worth taking note on is how far away from the 10 we are. Want to continue to keep that in focus. This is the cumulative volume index. On Thinkorswim, it will only give us so many choices. So I'll just open it up here. You can see we have the NYSE, the NASDAQ, and Amex. That's okay. I went ahead and I modified it a little bit. I put these Bollinger Bands around it, and I added some moving averages, the 10, the 20, the 50. It's all right. It's fine. I keep it pointed at the NASDAQ. But it would be better if we could look at the total one, right? On TradingView, they have the same thing, cumulative volume index as an indicator. So we just come in and say, bring in the SPX or something like that. We're on a daily chart, indicators, cumulative volume index. The one on TradingView lets you do all of the US markets. You can see you got NYSE, NASDAQ, Amex, the Dow Jones, but this one right there, US total. This gives you the cumulative volume for all of the US indexes combined. I really like that. It's worth keeping your eye on. Think of it as net volume. If it's pointed up, it's net buying volume. If it's pointed down, it's net selling volume. And we want to look for discrepancies or divergences. Price setting higher highs while this line is setting lower lows, something like that. To make it easier to try to read the two together, turn your price chart into a line chart. That way, when you stop your mouse at one spot, you can compare what the two lines are doing. Back here, for an example, the indicator continued to go flat and higher, and price had started to sell off. So we can use it for divergences, all sorts of things like that. Now that I've turned this into a line, you can see how the S&P has continued this rally from like 5,200 to 5,430. And we'll just zoom in on this cumulative volume here. We can see now that I've zoomed into it, that same perspective. It started a little bit little bit early. It was actually started to go up before the S&P had started to go up. And it's already started to turn down while the S&P is continuing this upward move. Now, this is one day, right? One day, and that doesn't amount to very much. We want to look at it after multiple days, but everything starts with that first day, right? The first day, the first minute, the first hour, it all has to start somewhere. So keep that in mind. We've got a little bit of divergence starting, and we want to see it if it's going to play out, that we lose more of this cumulative volume if and when we see the indexes continue to the upside. So we got gold taking off. It's back up to that 2350. Kind of needed to do that. It needed to get back up there. It's almost getting into a decision model that was going to take away all the choices, and it was just going to give us one direction. So I'm glad we're back into a two-sided environment on that, but it kind of needs to keep it. We've got an inside day breakout started. We're outside of yesterday's range. We even buzzbeat off of it after we broke out. Now that we've got it, we need to keep it. Volatility's picked up a little bit on that. Same thing with crude. Inside day breakout, nice expansion. No buzzbeat yet, but we want to kind of keep our eye on it, see if we're going to get anything out of there. So I'm pointing these two out because at least they're doing something. If we end up stalling today, which is absolutely possible, we could get some that econ and then just stall out. It's Friday, hold the line, you know, next week's OPEX. We could get a market that just says, yeah, we've done enough. And we just go sideways for the rest of the day and even into next week. And if that's what we get, it's going to chew a lot of you guys up if you're just not, you're not ready for it. Find something else. If the expansion continues up or down, you know, the S&P and NASDAQ could rally back after last night's move, then great. We've got something moving and we can play those. But if they do go sideways, maybe look at gold or oil or something, right? Find something else that's offering you better opportunities. Or the Russell. It's down the most. I'm going to keep pointing that out. Yesterday, I started digging deeper into the 30-year bond auction on the expectation that I've found some examples where the 30-year was nothing. We get it, and we didn't see any response out of it. But more often than not, that 30-year brings change with it. Yesterday at 1 o'clock, we got the 30-year, and everything changed, right? So I went out and just marked the 30-year for 2024. I found it difficult to find more information on the 30-year prior to 2024. And I thought, well, you know, it really don't matter. We'll just start keeping track of it from here on out. So there's been a few occasions where the 30-year produced nothing. Here's one day on the 8th where we had a 30-year bond, and there was just, as you can see, look at that tiny little doji day, maybe a spinner. There's nothing there. But most of these, when we got the 30-year, had a really nice expansion day. So two that were a dud, and then the rest of these were just really good. I think I'm going to add the 30-year into a new playbook. For the floor pivots today, we've got a pivot channel that is touching or within the previous day's channel, so a little bit of an overlap. Price did not open or even get to an R1 level. We've already passed through the pivot point, so it's not an MDP. It is a narrower channel, which implies we could expand today. Just keep in mind that the narrower the channel, the more likely it is that we could expand. This is narrow in relation to what we had yesterday, but it's not as narrow as it could be. These channels can be so narrow you don't even see any of the yellow at all. You just see that purple line. So it can be so narrow that it's like, what channel? I don't see a channel. That's narrow. What we have here, sure. I mean, look at yesterday, look at today. This is much skinnier than yesterday's, but it's still not as skinny as it could be. And keep in mind that these channels don't make price expand. The wide channel doesn't stop price from expanding. It just gives us insight or perspective on what kind of day do we expect to have. If it's a really wide channel, we don't expect the market to expand, to break out and continue moving in whatever direction it broke out of. When it's a narrower channel, we expect that if the market breaks out, it could continue to expand. It's just a really good starting point on trying to figure out what kind of trading day do we think we're going to have. Now, we did get below the S1. Generally speaking, if we get into the RTH below the S1, then S1 is going to act as a resistance level, and we'll find it difficult to get through that to come back towards the pivot. We're above it right now, but we do have econ that's going to likely change that, give us some volatility. But keep that perspective in mind as we get into the RTH open at 9:30. Are we above that green line or below it? If we're above it, then it may act as a support and we can come back up to this pivot point. But if we open below it, it's going to act, very likely it's going to act as resistance, and we could continue the drive to the downside. The go-to with these is an S1 equals an R2. So we'd be looking up here, 54.75. An R1 equals an S2, and we'd be looking down here at 53.88. It doesn't have to do that, though, right? Just keep that in mind. There's plenty of times where we get through an R1 and go all the way to the R3, and we never go in the other direction at all. It is worth noting that when price gets to an R3, it is considered a short. Just like getting to an S3, it is considered a long. For newer traders, that might confuse you. Experienced traders are going to see that and say, of course, we went really far in one direction. We're going to mean revert a little bit. Yep, that's exactly it. We also have to keep in mind how far away from the weekly pivot we are, right? We are a long ways from that weekly pivot, but I mentioned this at the start of the week, and I used last week's weekly pivot for my example. And I said, when we get too far away from that, we often just stall out, and we really have a hard time going any higher or lower if it was the other direction. And we did the same thing this week. We got, quote, too far away, and we really struggled to go any farther than that. I've tried to quantify many times how far is too far. Exactly how far away from that pivot can we get before it's too much and we just can't get any farther away. I even built an indicator to look at it, but there was no insight there, disappointing as that is. So I don't have a quantifiable way to say we've gone too far from the pivot, but it is something that I continue to focus on, as you should every day, just kind of asking that question. How far away from that weekly pivot point are we? For the ADR today, we've already made it to the red ADR, the lower ADR. And when we get to the ADR this early in the morning, it opens the opportunity for us to go to the other side. A little bit like mean reversion, if you want to think of it that way. But the way that I like to think about it is what the ADR represents in the first place. ADR, average daily range. It's a 21-day ADR, so it's looking back over the last month, and it's just asking a basic question. what did the market do on a day-to-day basis over the last month? From its highest point to its lowest point, what has the market generally done? It generally moved about 0.92%, and that was the range. Now, think of that range like a bubble around price from the previous day's close. And if we make this bubble about 1% or 0.92%, every day at the close, we can look at the next day and say, how far should the market move? As high as this bubble and as low as that bubble. And that's what we get in the next day. And we can take that bubble back and look at every day from this close, what did the market do the next day? Just slide it straight across. It went about the same, expanded to the outside, but came back in. The next day, the next day, the next day. I would love to find a charting platform that actually put a bubble around price, whether as a 1 standard deviation or an ADR level or anything. Instead, they like to use channels. Keltner's, Bollinger Bands, acceleration bands, and those bands, as good as they are, they're just not that bubble. Oh, that's my own pickiness, I guess. But really, at the end of the day, it's just a channel that we're staying in. We expect to hit both sides of the channel because that's what price did. It hit the upper edge and it hit the bottom edge, upper edge and bottom edge. And then we get the outliers, these big candles that expanded beyond the red and went all the way to the yellow because it is 0.92%. Price can open and move 0.9% in a single direction. We can open and go 0.9% in a single direction. So it is possible that we just move in one direction. But oftentimes the market opens and we go both directions. Since we've already gone to the bottom early enough in the day, we could go to the other side. And we're at the cog line right now, 54.11. Someone mentioned the gaps on the SPX. There has been a lot of gaps, but I'm going to assume it's this Wednesday gap. And absolutely, closing that gap is on the table, especially when you think about where the ES is at right now. The SPX obviously doesn't move in the after hours, so we don't have anything to see here. But if we take the ES price-wise and just look at the structure, the gap from where we opened Tuesday night into Wednesday's Globex, that would be Tuesday's close. Just like the S&P, we're looking at Tuesday's close. And are we going to close that gap? The ES made a really good shot at it already, right? That round number, 5,400, kind of acted as a support. We don't have necessarily that same round number since we're going to be completely outside of yesterday's range. We'll already be below 5,400 in the SPX, but it is going to put us really close to that Tuesday close. If the ES is at the Tuesday close, the SPX will be at the Tuesday close. That way, even though the numbers don't match, the price structure will, right? Yesterday's high, yesterday's low, Tuesday's close, those things are should be very close in their matching perspectives. So if the ES is down there by the open, so will the SPX. The thing is, we got data, and so we could hold that 5,400 in the ES and rally back up. And if we get back inside of Thursday's range on the ES, then the SPX will open inside of Thursday's range, and it won't have that gap closed. That gap close is haunting us. It's not the only one, but it's the biggest one that we've got for a while. Here's another one down here that still hasn't closed. But that's at 5,300, and maybe hopefully we don't see that today. It's a bit of a reach. So the volatility trigger, the 10-day moving average, the 3-week, and the 20-day. And we're at the cog line 5411. We got the round number 5400. We've got a lot of pivots, and they are hedging this morning, right? They are concerned about the data that we're going to get, and they're spending money to protect their position. That is important to know. Generally, we would say that and say, watch it with the volume. It's probably going to be really light, and that is not the case. We've got a lot of volume coming in. A lot of your platforms have already started to automatically roll the futures contract, so pay particular attention to what you're trading on. TradingView already did it this week. Thinkorswim is going to do it over the weekend so that when you come in on Monday, it'll be a new contract. I don't know necessarily which one of those behaviors I like better. Probably the Thinkorswim one, where you just come in, it's a new week and you've got a new contract rather than doing it midweek the way that TradingView did. I just think that's a little disingenuous because I've seen a couple of people that were caught off guard with that. Tradevate doesn't necessarily have the best charting. And so I know quite a few people are using the dome on Tradevate and using the charting on TradingView. So just check your contracts. Get into the habit of doing that and it becomes normal. But, when you are starting out, it's just something that can slip by you and give you grief. $10-day, 30-minute volume profile with the TPO. We still haven't seen the point of control move up yet, which is not a surprise, but we are getting enough volume that we could start to see this high volume node build out more, and we could bring our point of control up. We keep falling away from this zone, and I think if we continue to fall away from this zone, that we're going to end up back down here and we'll build out more volume down here. We're not going to lose any candles out of this structure until late next week, Wednesday afternoon into Thursday. And if we're down here again, building out more volume at that level, then even if we're losing candles on the left side, we're printing new ones here on the right side, and that point of control still isn't going to move. Yeah, a lot of the education, when I first learned futures, most of the education said the contracts should be rolled manually when the new volume is greater than the old contract's volume. And so, the way I have my Tradevate set up is I can see the volume on both contracts, and I stop trading one and I start trading the other when I see that the new contract has more volume. So, the auto is fine. There's nothing wrong with having the machine just automatically roll your contracts for you, but I was taught to do it manually. I've always done it manually. And I don't know. I just like having control of it myself. But it is a good rule of thumb, absolutely. When the new contracts volume exceeds the old contracts volume, it's time to swap. So we kept that point of control on yesterday. It wasn't a VPOC, it was just a point of control. And price did respond to that level multiple times. Now, sure, during the announcement yesterday, it ran right through it like it wasn't even there. But after that, it still was respected as a significant level. So, the idea of carrying forward the point of control every day and even the weekly and monthly points of control, there is merit to that. I don't do it because I've already got enough pivot points. So I only carry forward the ones that have not yet been touched. That doesn't mean that I'm right and you're wrong. It just is our needs are different, right? So if you're carrying forward the pivot point or the point of control every day, whether it's been hit or not, then there's nothing wrong with that at all. I would suggest that if it hasn't been hit, just leave it on there. Whereas if you're carrying forward the one from yesterday, once the day is done, just go ahead and delete it. You don't want a bunch of these stacked up, from 2 weeks ago where we've already crossed through that level multiple times, and maybe it doesn't have any weight anymore. But speaking of these pivot points and marking out levels and keeping it forward, there is an argument about anchored points of control, specific days. Now, if you're looking at equities, it could be earnings, maybe a news announcement, a new drug trial, something like that. When it comes to the futures, it could be maybe just economic events. The day where we get an FOMC event, or maybe a CPI or non-farm payrolls, some specific day where things changed, and you keep that day's point of control and carry it forward until that contract expires, and then you get into a whole new contract series. To me, I don't see any reason to carry forward things that belong to an old contract, because we're carrying forward these levels on the expectations of unfinished business. Traders got in at this level. The greatest amount of trading activity happened at this level, and if we revisit it, we could anticipate some unfinished business from those traders. But once we're in a new contract, there is no unfinished business at that level. Sure, they could have rolled into a new contract, and then they may be still concerned with that level, but I've carried forward levels from a rolled contract, and when we did go back and visit those levels, I didn't see a significant difference in the order flow around those levels. I didn't see the unfinished business. So, at some point, you just got to clean up the charts and take those levels off. Now, carrying forward levels on stock, well, stock doesn't expire, so why not? This morning's profile, we've got a little bit of divergence between the amount of volume that we have at this lower level versus the amount of trades we have at this lower level. So in green, we've got two different D profiles, which is the B profile, and the point of control is in the lower end, but in the TPO, the point of control is still across this high up here. It's got more of a classic P shape, whereas the volume's got that 2 double D. Now with the 2Ds, we still got the representation of what each D represents on its own. We just want to focus on where's the volume at. One way to look at that is that the market sold off and they tried to front run it. Look at the low of yesterday and look at where that point of control is. The greatest amount of volume took place above that level. They tried to protect it to stop price from even going through it. That didn't work. But once we got back above it, there's still been a lot of trading there. It really looks like they're trying to defend this level. We got a lot of volume down here. Even though we spent more time across this high last night, we spent more time up there. We've got more volume down here. Having a profile, if this was just a lower B with the point of control, that's bullish until it isn't, right? So we'll have to see how it goes. But having that volume down there is a good start. If we get back below that level and say get outside of yesterday's price again to the downside, this is going to be significant resistance over our head for the rest of the day. And we're going to want to watch to see if we make yet another D shape in the profile today and bring that point of control down even lower if we do make this breakout. So right now, we are right there at the point of control. There's no edge in trying to call it support or resistance at this point because it's just so close to us. But if we get below yesterday's low again and we really get away from this point of control, when we come back to it, it will be acting as a resistance level. It's one more structure we're going to have to get through. The easy thing about it is it's at the point of control with the cog line 5411. So at least we have those center of gravity. We can see next week's range, but this range is not yet set in stone. So this is just a preview of what next week's trading range is going to look like. Next week is a short trading week. That always screws with us when we're trying to figure out, is there more volatility priced in for next week or less? The range may be the same size as the current week, but if there's less days, then that means there's more volatility. And the crazy thing is the range is actually wider next week than it is this week. That means they pumped a lot of volatility into next week. I'm shocked to see it like this. The day isn't done yet, and this range could contract before the end of the day. But right now, they're pricing in a lot of volatility. I don't exactly know what I want to do with this. I'm surprised to see it this big. The distance of this box is set by average implied volatility within that week. If you don't have Thinkorswim and you want to do this for yourself, as long as you've got a futures charting platform that has options like Thinkorswim does, we can go to next week and we can see the number here, 75 points higher and 75 points lower. Add that together, we got what, 150? So a combined range of 150 points. But there's only 4 trading days next week. So maybe we're on the wrong date here. No, that's the right day. They skipped Wednesday, Monday, Tuesday, Thursday, and Friday. We're right. You could look at the AM, but I would say look at the PM, right? Because we need it Friday to the close, not Friday morning. That is a lot of volatility priced in there. Surely it can't just be because of OPEX. Although, I mean, maybe it is. I don't know. We'll talk about it more Monday because I'll have more time between now and then to examine why we have so much volatility. But either way, this right now is telling us and projecting that next week has a lot of volatility priced into it. The holiday that will close the markets next week is Juneteenth. So, it's shorter options week, shorter trading week. There should be a smaller range. We're more than a 0.5% above the 10-day. So we're not, out of line. We haven't moved too far too fast. It doesn't owe us any sort of pullback or mean reversion. And for the weekly perspective, we're now in that sweet spot. We want to stay about 2.5% away from the 10-week. That's where we've been, when we had that really nice run from November all the way up into mid-April. We just stayed in that zone between 2.5 and 3.5, maybe a little higher now and then. That's the spot we want to be, which just keeps us in that focus that says, no, we're not overbought. We're not overextended. We did get outside the box this week, and there is a focus on getting back inside the range. This is the range that we should have stayed in. So 54.11, the cog line, kind of the high side of this range. We want to get back below that. It really looks like yesterday's low and this box line up really well. So you could just use that. I know if we nerd out and really kind of zero in here, 54.08, I wouldn't get that specific with it, right? Technically, we close inside of these boxes 80% of the time on the S&P, but a 1 standard deviation is what this represents. And a 1 standard deviation is like 68 point blah, blah, blah percent that we close inside the box. If it was anything other than the S&P, that would be our expectations. This is presenting as a rollover, though, after that really big breakup and that bit of a doji yesterday. So now we want to keep our eye on this biggest bar. It's the breakout bar, but it also just provides a key level for getting our measured moves. Bring it over to a nice clean chart. $54.17 is resistance for us right now. If we try to rally back in the other direction, that's something we're going to have to contend with. It's the half back from Wednesday, that really big day from FOMC. There is another drawing tool called regression line. You could start it from this last swing low, and it doesn't matter where you're at, just what candle you're on. So if I start here, May 31st, and I drag it across, we can see the linear midpoint. Consider it the mean if you want to, the average. We can also open it up and redraw it as a channel. So think it's just right clicking on it. Yeah, redraw as channel. So now you've got a regression channel line based just on this last swing. Gives you your low structure, the mean or the midpoint, the high end of this. This market maker move gives us an additional distance that we could go today. It's 22. Now let's round up and say 23 points. So from 54.85, you would add another 23 points to the upside. And from 53.86, you would subtract another 23 points to the downside. That would be what, like 64 to the downside. And 5507-ish. Line disappeared. I screwed that one up somewhere. There we go. That's what the market maker move gives us, is that additional distance that we could travel. So we could go all the way to 5,500 today, and it wouldn't be considered an outsized move. We could go all the way down to 53.64, and it wouldn't be considered an outsized move there either. It would put us back in that box, that waiting box that we were in. And I think if we get in that, we could get stuck there for a little while. So generically, we've got finance down, not necessarily banks per se, but finance. That could be mortgage and lending institutions, could be trading desks like IBKR or Schwab. You know, it could be insurance. So finance is kind of a generic word, XLF, but it's down close to 1%. Industrials right behind that, solar, China ADRs, then the banks. To see KRE there. There's your regional banks, more than 0.5%. Semiconductors, airlines, building materials. It's pretty broad based, just about if we were to count up the sectors that were down out of the top 9, we'd have a perspective that about everything is down this morning. If we look at what's up, gold miners, Bitcoin, bonds, it shows expanded tech almost at a 0.5%, but IGV is one of those tricky ones. It often doesn't get morning flows. So you always want to go in and check when you see IGV and see if it actually is getting morning prints. Oftentimes what happens is it'll move in the after hours the night before, and then it won't move in the pre-market, but it'll still show that it's up or that it's down. So we can see that we got a print this morning. And we went into the close down here. So, technically we're up, but I'm not seeing any real flows. That's just a print, just an algo print, like a dark pool or something. So I'm not seeing an extended tech looking all that bullish. It is good to see bonds up. We want to continue to see that. We've had some wild moves this week in the dollar. And again, we have that discrepancy. We got the 10-year. It's broke outside of yesterday's range, continuing to expand to the downside, testing lows of the day, trying to make new lows. And the dollar is inside breakout to the upside. It's back in this channel that we had drawn. Just put that on a bigger screen. So we got this range here, and we're back in the mess. 105.78 or 105.80 area where we would expect the dollar to stall out. If it gets above that and into 106, I think the market's going to really feel that. So remember, we're not looking at tit for tat for every tick the dollar moves in one direction. We're not expecting the equal and opposite move in the other direction. It's not like that right now. Instead, it's more of a focus on where the dollar is, above 104, above 105, 106. And we've been holding underneath this 105 and 8 or underneath 106 since late April. Think about what the market's been looking like since late April. So if this gets above here, I think the market's really going to change its structure. Something to be concerned with. On the day, just getting beyond this yellow line and expanding higher today would be extreme. The NASDAQ is not inside day breakout. So with the S&P, if we do reverse again, say with the econ we get or whatever, I would look for the NASDAQ to break yesterday's low to see all of the rest of the market really start to get short. But we're not that divergent. The NASDAQ's down 0.19 and the ES is down 0.39. So they're not far off. And we have pot stocks up this morning, although they're not really getting much bullish flow, just some prints off of these lows. From a low risk entry point of view, pot stocks being at these levels offer an opportunity for a long trade, not because there's any sort of bullish implication here, just that going long from the lows is the least amount of risk you could ever take. Might look into that. If I put on a new hot stock trade, I'll let you guys know. I'm still carrying MSOS shares and options. I've defended my shares trade with some options trades just because that has been seriously underperforming. It's also breaking this low, could get a really nice double bottom bear trap here, or it could just continue to fall out of bed and we'll see it at $6 next month. But we do have pot stocks behind that, gold and gold miners. That at least is getting some flows this morning, but you can see the wicks across the top. They are defending that. Look for an inside day breakout on this, get it back above 34. We can measure yesterday's candles and plot those levels up and down, but I would be focused mostly with the halfback. Let's get through the halfback and keep it. Round number 3350 looks good. Stay above that, maybe use it for support, see if we can get that breakout started. With GLD, we've already got the inside day breakout started. Now we need to keep it. We can see this selling structure off of this really large candle here, the halfback. The halfback rejected this day on June 12th. So now here we are trying it again. If we can get above that, try using it as support, some structure. Crude also up, a little bit of a mean reversion after this really big dump. And of course, if we got gold, then we should get silver. But silver's not even inside day breakout yet. Focus on the midpoint of yesterday, that halfback. Hold above that level, see if we can engineer a breakout on this. Again, selling from the 12th. That high and even that midpoint of that day will be a level to focus on for resistance. And Bitcoin, bonds. The thing is, we can't get a sustained S&P NASDAQ rally today from pot stocks and solar and Bitcoin, right? Crude. We need more. So watch the Mag 7, the semis, see if they turn around and start driving to the upside. That could turn us around. And even just the indexes themselves start getting flows, turn things around. Otherwise, it's looking like a sideways day. The cumulative delta on the S&P is really bullish off of these lows too. And we have an inverse head and shoulders on the ES. So like a failed bear flag breakout play to the upside. So unless econ slaps us down, we could at least perhaps retrace the move from the overnight. What I got for you guys, be careful, be safe, have a good weekend. I will see you all next week.